The most dangerous trade on Wall Street is not the risky one, it is the trade everyone agrees with. Because when every man in the room believes the same thing about the market, something important has already begun to happen. Positions start gathering on one side. Confidence grows stronger with every passing hour. And slowly, without most traders noticing, the market becomes fragile. My name is James R. Keene. I spent many years on Wall Street watching speculation unfold, not only through numbers and prices, but through the behavior of the men who believed they understood them. Over time, I learned that markets rarely collapse because traders are afraid. They collapse when traders become certain. October 1906, New York City. The financial district was calm that morning. The streets around Wall Street filled slowly with clerks, brokers, and messengers moving toward the offices that controlled the nation's capital. Inside brokerage houses, the ticker tape machines had already begun printing their endless stream of prices, thin strips of paper carrying the pulse of the market across the room. On the floor of the New York Stock Exchange, the noise of trading followed its familiar rhythm. Brokers moved quickly between the trading posts, shouting orders and recording prices, while clerks attempted to keep up with the constant movement. To an outsider, the scene might have looked chaotic. To those of us who had watched it for years, it was simply another morning of speculation. And yet something in the air felt different. Not panic, not excitement. Confidence. Railroad companies were expanding across the country. Industrial firms were reporting strong profits. Newspapers printed optimistic headlines about American growth and the strength of its markets. Investors from across the nation were sending money to New York, convinced that the rise in prices would continue. Inside the brokerage offices, men spoke with certainty. Some leaned over the ticker tape, reading the latest prices while discussing which stocks would climb higher. Others studied reports and balance sheets, convinced they had discovered the next great opportunity. Confidence is a powerful force in speculation. When traders begin to believe the market is predictable, they start taking larger positions. They borrow more money, they increase their exposure. Caution slowly disappears because success appears almost guaranteed. I had seen this pattern many times before. The most dangerous moments in speculation rarely begin with fear. They begin with agreement. Because when too many traders believe the same story, the market begins to lose its balance. Buyers crowd together, positions grow larger. The entire structure of the market becomes dependent on a single assumption, that prices will continue moving in the same direction. For a while, that assumption often appears correct. Prices rise, confidence grows, more traders join the same side of the trade. But beneath the surface, something else begins to build. Pressure. Like a spring slowly tightening, the market absorbs more and more speculation until it reaches a point where the smallest event can release it. Most traders never see that moment coming, because when confidence fills the room, doubt becomes difficult to hear. Over the years, I watched many fortunes disappear in exactly this way. Not because the traders were foolish, but because they believed the safest trade on Wall Street could not possibly fail. They believed the crowd must be right. But markets have never shown much respect for crowds, and the day I am about to describe began exactly like that. With confidence, with certainty, and with a trade that almost everyone believed was safe. In the weeks that followed, the confidence on Wall Street continued to grow. Prices moved steadily higher, and each new rise seemed to confirm what many traders already believed, that the market had entered a period where profits were almost guaranteed. Inside brokerage houses, the conversations were always the same. Men spoke about opportunity, about momentum, about the simple logic that rising markets must continue rising. Orders arrived from across the country. Investors who had never before speculated in stocks began sending their money to New York. The market was becoming crowded. At first, the movement looked healthy. Buyers appeared throughout the day, pushing prices higher, while sellers slowly disappeared. Stocks that had once moved cautiously now climbed with increasing speed. Each new rise strengthened the belief that the market had discovered a reliable direction. But experienced traders understand something important about markets. A market that moves in only one direction eventually attracts too much confidence. And confidence attracts speculation. Men who had once traded carefully began borrowing larger sums of money. Brokers extended credit to clients who wanted to increase their positions. The system of speculation that supported Wall Street, leverage, loans, and margin accounts began expanding rapidly. From the outside, everything appeared strong. Prices were rising. Business was growing. Newspapers praised the prosperity of American industry. But markets rarely reveal their weaknesses during moments of optimism. Those weaknesses appear quietly beneath the surface. When too many traders stand on the same side of a trade, something subtle begins to change. Buyers become less cautious because success appears easy. Sellers become fewer because few people wish to bet against a rising market. The balance between supply and demand slowly disappears. And when balance disappears, the market becomes unstable. I had watched this transformation many times before. Speculation begins with opportunity, but it often ends with excess. The first traders enter carefully, the next group enters with enthusiasm, and finally the crowd arrives with certainty. That is when the trade becomes dangerous. Because by the time the crowd discovers the opportunity, the market is often already close to its turning point. Yet very few men notice this shift while it is happening. Instead, they see only the profits that have already been made. They see the rising prices. They hear the confident voices around them explaining why the market cannot possibly fall. Confidence spreads quickly in such an environment. Inside the brokerage offices, the mood grew louder with each passing week. Traders compared their profits and spoke about the positions they planned to increase. Some believed the market might rise for years. Others believed the expansion of American industry guaranteed higher prices for nearly every company listed on the exchange. But markets do not move according to certainty. They move according to pressure. And pressure had been building quietly beneath the surface of Wall Street. Too many traders were now standing on the same side of the market. Too much borrowed money supported their positions. Too many fortunes depended on the assumption that prices would continue rising. From the outside, everything still looked stable. But beneath that stability, the structure of speculation had begun to lean heavily in one direction. And markets have a habit of correcting such imbalances without warning. All that is required is a single event, a rumor, a failed position, a sudden withdrawal of confidence. And once confidence begins to disappear, the crowded trade can reverse with remarkable speed. Most traders never believe such a reversal is possible until the moment it begins. The problem with crowded trades is not that they begin badly. In fact, they often begin very well. Prices rise exactly as traders expect. Profits appear quickly. Early successes convince others that the opportunity is real, and with every passing week, more investors join the same side of the market. By the autumn of 1906, this process was already well underway. Large pools of capital had begun concentrating in the same group of stocks. Brokers encouraged their clients to expand their positions. Banks provided the credit that allowed speculation to grow larger than the actual money behind it. Leverage spread quietly through the system. A trader who once bought $10,000 of stock now controlled $50,000. Another who once traded cautiously now held positions far larger than his capital could safely support. As long as prices continued rising, the structure held together. But markets supported by borrowed money depend on something fragile: confidence. If confidence remains strong, speculation can continue expanding for a surprisingly long time. But if confidence weakens even slightly, the same leverage that created profits begins forcing traders to sell. And when many traders are forced to sell at the same time, the market moves quickly. That was the risk forming beneath the calm surface of Wall Street. Inside the exchange, the noise of trading continued as always. Orders arrived throughout the day. Brokers moved from post to post, shouting prices, while clerks recorded the endless stream of transactions. To most participants, the market still appeared strong. But experienced traders watch more than just prices. They watch behavior. I noticed something subtle beginning to change. Some of the strongest buyers in the market had stopped adding to their positions. A few large operators who had previously supported the rising trend now traded more cautiously. They were not selling aggressively, but they were no longer pushing prices higher with the same confidence. To most traders, this change went unnoticed. But the market had begun to hesitate. Prices still moved upward from time to time, yet the strength behind those moves was weaker than before. The crowd continued believing the same story, but the market itself had become less enthusiastic. Such moments are dangerous, because when the market stops responding to optimism, it often means the buyers who drove the earlier advance have already taken their positions. The crowd remains eager to buy, but the strongest hands have already finished buying. That leaves the market balanced on a fragile foundation. It was during this period that I began observing the trade more carefully. Not because I believed the market would collapse immediately, but because I had seen similar conditions before. When speculation grows too confident, when leverage becomes too large, and when too many traders depend on the same outcome, the market begins waiting for something. Sometimes that event is small. Sometimes it is almost invisible. But once it arrives, the crowded trade begins to unwind. And when it does, the movement can be sudden. The traders who believe they were holding the safest positions in the market discover something uncomfortable. The trade that once felt stable now requires constant defense. Prices begin moving in ways that were not expected. Profits shrink. Confidence weakens. And once confidence weakens, the structure of speculation begins to shift. At first, only a few traders notice the change. Then a few more? Eventually, the entire market begins to feel it. The crowded trade starts looking less certain. And when certainty disappears from Wall Street, the market rarely remains calm for long. At first, the change was almost invisible. Prices stopped rising with the same confidence that had carried them through the previous months. The market still moved upward from time to time, but each advance felt weaker than the one before. What had once been steady progress now looked hesitant. Most traders ignored the difference. After all, markets rarely move in a straight line. Small declines and pauses are common even in strong trends. Many believe the hesitation was only temporary, a brief pause before the next rise. But the problem with crowded trades is that they depend on continuous confidence. And confidence had begun to weaken. Inside the brokerage offices, the conversation slowly changed. The certainty that had filled the rooms weeks earlier was now mixed with small questions. Some traders began discussing whether prices might be moving too quickly. Others wondered if the market had become too optimistic. Yet the majority still believed the advance would continue. That belief kept most traders in their positions. But beneath the surface, something more dangerous was developing. A few large operators had begun quietly reducing their exposure. They did not sell aggressively, and they certainly did not announce their intentions. Instead, they stepped away gradually, allowing the market to absorb their shares without attracting attention. This is often how large reversals begin. Not with panic, with silence. As the stronger hands stepped aside, the market became increasingly dependent on smaller traders and borrowed money. The same investors who had entered late in the advance were now responsible for supporting prices. That is rarely a stable arrangement, because traders who rely on borrowed capital cannot tolerate uncertainty for very long. When prices hesitate, their positions become uncomfortable. When prices decline, their positions become dangerous. The first real sign of trouble arrived quietly. One morning, the market opened slightly lower than expected. Nothing dramatic, nothing that suggested panic, yet the reaction from traders was noticeably different. Buyers were slower. Sellers appeared more quickly. For the first time in many weeks, prices struggled to recover. Throughout the day, the exchange floor grew louder as brokers shouted new orders across the trading posts. Some traders attempted to buy the decline, convinced it was only another temporary pause. Others began reducing their positions, preferring caution over confidence. The market continued slipping lower. At first, the movement was modest, but when prices fall in a crowded trade, the decline carries a dangerous momentum. Traders who borrowed money to build their positions begin receiving calls from their brokers. Additional capital must be deposited to support their trades. If the money cannot be found, the positions must be sold. And forced selling pushes the market even lower. By the afternoon, the pressure had grown stronger. Stocks that had climbed steadily for months now moved sharply downward. The optimism that had once filled the brokerage offices began fading, replaced by a quieter and far more uncomfortable emotion: doubt. On the floor of the exchange, the noise of speculation was now mixed with urgency. Brokers moved faster between the trading posts. Messengers carried instructions from nervous investors. Prices changed constantly as the market attempted to absorb the growing wave of selling. The crowded trade was beginning to unwind. What had once felt safe now felt uncertain. And once uncertainty enters the market, confidence rarely survives for long. Because traders who believed they understood the direction of the market were now discovering something difficult to accept. The crowd had been standing on the same side of the trade, and the market had begun moving the other way. Once the market begins unwinding a crowded trade, the process rarely stops quickly. What had started as a small hesitation now grew into a steady decline. Prices moved lower day after day as traders who had once been confident began searching for a way out of their positions. The same men who had spoken so comfortably about rising markets were now watching the ticker tape with quiet concern. At first, they hoped the decline would end quickly. Markets often recover after a few difficult sessions. Many traders believed the fall was only temporary, a correction before the advance continued. But the structure supporting the market had already changed. Too many positions depended on borrowed money. Too many traders were trying to exit the same trade at the same time, and the buyers who had once driven the advance were no longer willing to absorb the growing supply of shares. Confidence was fading. Inside the brokerage offices, the atmosphere felt very different from the optimism of previous weeks. Conversations were quieter. Traders studied the tape more carefully. Each small rally in prices was met with relief, yet those rallies rarely lasted long. Selling returned quickly, because traders who had been trapped in the crowded position now used every rise as an opportunity to escape. This is how crowded trades usually end. Not with a single dramatic collapse, but with a slow and uncomfortable realization spreading across the market. One by one, traders accept that the opportunity they believed was certain has become something far less predictable. The crowd begins to retreat. Positions shrink. Leverage disappears. And the same trade that once appeared safe becomes the source of unexpected losses. From where I observed the market during those days, the lesson was already clear. The greatest danger in speculation is not volatility, it is certainty. Markets do not punish traders for taking risks. Risk is part of speculation. What markets punish is the belief that a trade cannot fail. When too many traders believe they have discovered the safest position on Wall Street, the market quietly prepares its correction. Because speculation depends on balance. Buyers and sellers. Optimism and caution. When that balance disappears, the market begins searching for a way to restore it. And it often does so with surprising speed. Over the years, I watched this pattern repeat again and again. New traders arrived, convinced they had discovered a reliable strategy. Crowds gathered around the same opportunity. Confidence grew until caution disappeared. Then the market reminded them how speculation truly works. My name is James R. Keene, and after many years observing the behavior of markets and men, I learned one lesson that never seems to lose its relevance. The trade everyone agrees with is often the most dangerous trade on Wall Street. Because when the crowd feels safest, the market is usually preparing its next surprise.